think it's going to be an interesting year. I mean, we're all kind of expecting a kind of a soft landing of the economy, but if you look at the period historically between interest rate hikes and where we are now, it's still very possible that we could also end up in a recession. So for us as a company, I think we're very well prepared for any of these scenarios. We've seen that we don't take interest rate positions on this, so it's been we've seen quite a bit of cycles. So I think we're well prepared for 24.
How are you preparing for recession?
Well, like I said, we don't take a bet on interest rates or financial markets. So I think from that point of view, we're neutrally positioned. Main impact is on customers. If we see big inflation, people having less money to spend, that could have an impact on our new business sales. But we've even seen in COVID, when we saw a very big drop in new sales, that majority of cash flows comes out of the existing portfolio. So that means that the business can sustain that very well.
Of course, here at Davos, we're all talking about the green transition in light of the extreme weather events that many countries are experiencing. In fact, the World Economic Forum catastrophe report puts extreme weather events as the #2 short-term risk. Indeed, 2023 was a very bad year for insured weather events like that. So how are you dealing with that from an insurance point of view?
Yeah. No, it's clearly a very big risk, and we've seen the weather becoming more and more extreme. I think last year we've seen, even in a country like the Netherlands, we've seen more rain than ever. And to be honest, it always rains in the Netherlands, but now it was even more. What we are experiencing is that we really need to work together with the government, because the government has been doing a pretty good job in creating overflow. 40% of the country, for example, is below sea level. So we need to deal with all the water that comes out of the rivers and out of the ocean. And then we combine that with insurance. And I think that type of partnership means that we can still have customers well protected. I don't think the government can do this alone, but we as an insurance company cannot carry all these climate risks ourselves. But I've seen some very good partnerships, and I think we in a way solved it with a terrorism pool. And now we're looking at how do we deal, for example, with flood risk. And I think it's very good because, the consumers need to still be able to get protection. And we shouldn't end up in a situation where insurance companies just refuse to underwrite any of that risk.
So there's the rub, and I'm going to use a personal anecdote to illustrate my next point. So I have a house, and last year my premium doubled. And when I rang the insurer and asked why, they said, well, it's now a perceived flood risk. And I said, yeah, but doubling. And they're like, yeah, but, building costs have gone up, supply chains have bottlenecks, like everything is more expensive. And then I said, but there must be a lot of people who can no longer afford to insure their houses. And they said, yeah, some people are having to drop their insurance. So at what point, I mean, you obviously have to raise your premiums to be able to insure against these events, but at what point does the customer then drop out?
Right. Well, that's why I think some of that risk you cannot carry as a standalone company. I mean, and we've seen a horrible floods, for example, in the south of the Netherlands, in Germany and Belgium in 21, and the damage is so big that a natural catastrophe has to be declared by the government. But still, in that partnership, you can still provide coverage, and you can provide the claim handling, you can try to immediately help. And I think the other thing we try to do is we try to avoid these hikes. So we've been consistently increasing premium, but let's be honest, the climate hasn't changed, at once. This is also an ongoing process. So we've been able also as an insurance company to step by step increase premiums and having to avoid these very huge premium increases that you're talking about, and that helps to also mitigate it a bit for customers.
Are you also trying to reduce your exposure to longevity risk?
Right. Yeah, I think longevity risk was our biggest risk, and we found a good way to offload this, and it was we could do it in an attractive way that supported our solvency ratio. Insurance premium was relatively low, so it was a very attractive deal for us. So we were happy to do that.
How are you using AI in your business? Because all these algorithms are increasingly be able to predict things like, someone who perhaps has a house that is more at risk of burglary, or someone who is more at risk of diabetes, or someone who, I don't know, is very likely to crash their car. So how are you using AI in your insurance business?
Yeah, it's a very good question. And I think, like probably many companies, we went through quite a journey. So we started with very cool stuff, like very hip things on all sorts of, and only then to discover we couldn't really scale it. And now we've really brought it back to some very concrete examples. So, for example, we have used ChatGPT very actively in our call center. So that means that every time a customer calls and the call is done, ChatGPT will already make a summary of the call Our colleague will just check it and it will automatically go into our customer database. So it saves around 4 minutes per call. Now that might not seem like a lot, but if you get millions of calls like we do, it's actually a very good savings. Another thing that we do is we use AI for claim prediction. So whenever a claim comes in, we can immediately use AI to predict how much the claim is going to be, and that helps to speed up the whole process. So I think there's a lot of upside. Today, a lot is around efficiency. I think over time, and that will be a debate in the industry, we will move more and more into further risk selection. But that also creates, in a way, we're undermining then the principle of insurance.
But in using this AI and generative AI, is there also the risk of bias, of the algorithms having a bias? Because this is something that we're still trying to grapple with.
Yes, no, absolutely. And I think that is
and they would unfairly perhaps put a higher premium on a customer than they should have.
And I think you run the risk that you start excluding parts of your customer database, parts of society that might already be in a weaker position. So this morning we had at Davos, I actually had the honor to lead a discussion on this in the financial sector on AI, and not only about the opportunities, which we clearly all see, but also on the risks. And one of our conclusions from our discussion group was that it's important for companies, certainly including ours, that we set an ethical framework and that we make very clear and transparent also how we deal with AI, what we're willing to do, what we're not willing to do, and report on it. And I think that transparency is needed so that people can start following, and it's not a black box, but people can start following whether the ethical principles that we have said, that we're following this. And I think the main principle on our side is that ideally you select on things that people can influence. So if it's behavioral things that people can influence, that could work. But there's other factors that people cannot influence, and those are the ones that you try to exclude as much as possible.
What do you think the market